You know, when a huge company buys another, we usually just see the big, flashy headlines. But behind the scenes, a really fascinating accounting puzzle gets started. How do you actually take two completely separate financial stories and weave them together into one single coherent narrative?
So, that's the million-dollar question, right? When one company takes control of another, how do we, on the outside, get a clear, combined picture of their finances? How do two sets of books become one single, truthful story? Well, that is precisely what we're digging into today with consolidated financial statements.
All right, so here's our roadmap. We're going to follow the story of an acquisition, step by step. We'll kick things off with why companies even do this. Then we'll nail down what control really means, uncover this mysterious thing called goodwill, watch how a new balance sheet is born, and finally, we'll see how they handle all their internal family business.
Okay, first things first, why consolidate? It's really all about seeing the entire forest, not just two separate trees. The moment one company gets control over another, they are required by law to show their finances to the world as if they were one single, unified organization.
And this brings us to a really crucial accounting principle, substance over form. What that means is the economic reality, the fact that one company is now in charge, is way more important than the legal paperwork that says there's still two different companies. For anyone trying to understand the business, that single combined picture is the only one that really matters. So that economic reality is the trigger for everything that follows. But what exactly is that trigger? Well, that brings us to Section 2, defining control. And you might be surprised to find out it's not always as simple as just owning most of the company.
So what is control in accounting speak? It's the power to call the shots. It's the ability, either directly or indirectly, to steer the management and policies of the other company. Think of it this way. It's not just about having a vote. It's about having your hands on the steering wheel.
So how do you get this control? Well, there are two main paths. You've got the old school way, the voting interest model. Super simple. You buy more than 50% of the voting stock. Done. But then there's a more modern and, frankly, more subtle way, the variable interest model. This is where a company can get control through some really clever contracts that give them the power to direct activities and, here's the key part, absorb the profits or losses, all without actually owning a majority of the shares.
Okay, so control is established. This leads us to one of the most interesting, almost philosophical parts of an acquisition. Section 3, goodwill. It really makes you ask, what is a company really paying for? I mean, what is a company truly worth? Is it just the sum of its physical stuff? You know, the factories, the equipment, the cash in the bank, the things you can actually touch and see on a balance sheet?
Let's start with the on-paper math. You take the fair value of everything the company owns, its assets, and you subtract everything it owes, its liabilities. So in this example, that leaves us with a fair value of net assets of $210,000. That's its value on the books.
Seems pretty straightforward, right? But, and this is a big but, what happens if a buyer is willing to pay more than that 210 grand? What is that extra money, that premium, actually buying?
Well, that premium is called goodwill. It's an intangible asset that pops up on the balance sheet, and it represents the value of everything you can't see or touch. We're talking about a stellar brand reputation, fiercely loyal customers, or that kind of magic spark of synergy you get when you put the two companies together. It's the price you pay for future potential.
And you know what? The math to figure it out is surprisingly simple. You take the price that was paid, you add the value of any part of the company the parent didn't buy, that's called the non-controlling interest, and then you subtract the net assets we just calculated. Whatever's left over, in this case $30,000, that's your goodwill. And just like that, a brand new asset is born.
So we've got our goodwill. Now it's time to put all the pieces of the puzzle together. Welcome to day one. This is the moment we create the brand new consolidated balance sheet for this new combined family.
Now this might look complicated, but trust me, there's a really clear logic to it. First, you just add all the assets and liabilities of both companies together. Simple. Then you tack on that new goodwill asset we just created. Now here's the crucial part. The subsidiary's original equity, you wipe it off the books. It's gone. In its place, the new consolidated equity is the parent company's original equity, plus that slice owned by any non-controlling interests. And boom, a new financial entity exists.
But you know, building that day one balance sheet is really just the beginning. Now these two companies have to live together. And that brings us to our final section, which is all about how transactions inside this new corporate family seem to just magically disappear.
The absolute best way to get your head around this is to think of the parent and the subsidiary as one big financial family, right? If you lend your brother 20 bucks, has your family's total wealth changed? No, of course not. The money just moved from your wallet to his. It's all still in the house.
And that's exactly what we see on their separate books before consolidation. The parent, Platonic, has a note that says, Socratic owes us money. That's a receivable. At the exact same time, Socratic has a note saying, we owe Platonic money, a payable. They are perfect mirror images of each other. But the second you pull back and create the consolidated statement for the whole family, poof, they're gone. They just vanish. That receivable and that payable cancel each other out completely. And why? Because from the outside world's perspective, no money actually left the family. It was all just an internal IOU. And hey, this isn't just about simple loans. You have to get rid of all the internal chatter. Any profit one company made by selling inventory to the other, gone. Gains from selling assets back and forth, erased. Internal interest payments, even dividends the subsidiary pays to the parent, all of it gets scrubbed from that final report. At the end of the day, the goal of all these eliminations is super simple: to show the company's finances as if none of that internal back and forth ever happened. It's about giving a clear, honest picture of how the family as a whole does business with the rest of the world.
All right, we've gone through the whole journey. So the next time you see one of those big merger headlines, what's the one single thing you should really remember from all this? It all comes right back to where we started, that idea of substance over form. When you read a consolidated financial statement, you've got to mentally erase the old company lines. You're not looking at two separate businesses anymore. You're looking at one.